Investing. When most people think of it, they think of day trading, complex charts, and people screaming at each other. But apart from what you've heard, investing doesn't really need to be complicated, overwhelming, or even boring. The basics are actually quite simple, and once you've nailed them down, you can make millions of dollars in your lifetime. So that's why in today's video, I want to take you from complete beginner all the way to making your very first investment. This is a super beginner friendly video with no jargon at all, and by the end of the video, you'll be able to answer why you should be investing, how and what you should be investing into, where you can begin investing, when you should start investing, and what to do after you actually invest your money. So if that sounds good to you, stay a while, make yourself a cup of tea and coffee, and let's get straight into the video. So why should you be investing? Well, the goal of investing is for your money to make you more money. Now, let's just say you start off with $1,000 that you've saved up from working at your part-time job. Now, what you could do is leave that in your bank account, but there's this thing called inflation that you might have heard about in the news. Now, the simplest way to demonstrate how inflation works is to look at how much it costs to buy a loaf of bread. Back in the 80s, you could buy a loaf of bread for 54 cents, but fast forward to today and you'd be paying around $3 for that same loaf of bread. The loaf of bread is exactly the same, but over time it's gotten more expensive due to inflation. So over time, your money actually loses its purchasing power. So that's why we want to invest so that it grows and then combats the effects of inflation. Now, another reason why you want to begin investing now is that so you allow time for your money to begin compounding. Now, the term compound interest refers to the interest that you earn on your own interests. Now that sounds a little bit confusing, but let me demonstrate it with a simple example. So let's say you invested $1,000 at the beginning of the year and you get a 10% return. Now at the end of the year, you're going to have $1,100. Now when you start that next year, if you get another 10% return on that $1,100, now you end up with $1,210. And now pretend that this pattern continues for another 20 years. Your money will continue to earn money on the previous balance every single year. So at the end of year 20, you're going to end up with $6,727. So just by investing $1,000 in year one and then getting a consistent return on your money begins to grow and grow exponentially faster the longer you have your money invested. And that's essentially the effects of compound interest. Albert Einstein actually famously referred to compound interest as the eighth wonder of the world. And he went on to state that those who understand it, earn it, and those who don't, pays it. Okay, so next let's talk about how do we actually invest. Okay, so the first thing to know about investing into the stock market is that there's a whole variety of different asset classes that you can actually invest into. We obviously have investing into the stock market, we have investing into real estate, you might have heard about bonds, government bonds or corporate bonds. You might have heard about people investing into watches, and you've probably definitely heard about people investing into crypto and NFT and either making a lot of money or losing a lot of money as well. And a lot of this can get complicated very quickly, so we're going to simplify things and just purely focus on investing into the stock market moving forward in this video, because that is the main thing that most people like you and I can invest into. Because you don't need a huge deposit to invest into real estate, nor do you need to take on an absurd amount of risk and essentially gamble your money like you do with crypto and NFTs. So stocks and shares are essentially the basics of investing, and when people talk about investing their money into the stock market, what they're essentially referring to is, I want to buy some stocks of Tesla, I want to buy some stocks of Amazon, I want to buy some stocks of Apple. And we'll get to that in the next part of this video. Okay, so what should you be investing your money into as a beginner in the stock market? Now, you've probably heard of people investing into individual stocks. You might have a friend who's bought some shares of Tesla or Amazon or something sexy like that. The thing is though, is that investing into individual companies or stocks can be extremely risky. Oftentimes the returns are a lot more volatile and unpredictable. It's definitely more like an active style of trading. So if you think of a day trader, essentially what they're trying to do is maximize their profit every single day. So they're making multiple trades, buying and selling stocks every single day, which is something that takes a lot of work to do because you have to be researching consistently about these companies that you're buying and selling, and it can add a lot of added pressure into your life, which we as beginners essentially don't want. And I'm going to cite Warren Buffett's opinion on this, which coincidentally is also my own opinion, and that is that unless you are a financial professional who does this full-time for their full-time job, buying and selling stocks, then you should avoid picking individual stocks.
The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them.
Instead, you should take a more passive approach to investing, which essentially just involves buying essentially the whole stock market and then essentially leaving it there and really doing nothing, and then only really check in on it once or twice a year and see your money grow over time. And you can do this by investing into an index fund. Now, what is an index fund, you might ask? Well, an index fund is a fund, and a fund is like a basket of stocks and shares. It can be other things, it can be other assets such as bonds, but in this scenario, let's just assume it's stocks and shares. And the index component essentially means that it tracks a particular stock market index. So for example, in the US, there is a really famous stock market index known as the S&P 500, which essentially represents the 500 largest companies in the United States. And we can see here that these are all of the components that make up the S&P 500 index. So we have Apple around 7%, which is the largest company in the world right now. We have Microsoft, Amazon, Alphabet, and more companies. Now, by investing into an S&P 500 index, your money will be split proportionally across all the companies that you see here on the screen. So if you had $1,000 invested into the S&P 500 index, this would essentially mean that you have around $70 worth of Apple shares, $60 worth of Microsoft, and around $26 worth of Amazon, and so on and so forth for the remainder of the 497 companies. Okay, so the next logical question is, where can you actually invest your money? Now, if you recall in The Wolf of Wall Street, Leonardo DiCaprio was on a phone call selling penny stocks, and when he would make a trade, he would essentially write that down on a piece of paper, and this is essentially how you would buy and sell stocks back in the olden days. Now, luckily for us, technology has evolved to a point where we actually don't need to pick up the phone and call our brokers anymore to make a trade, but we still do need to go through a middleman, but these are now in the form of essentially brokerage platforms and investing apps. Now, these days we are actually spoiled for choice when it comes to the various different brokerage platforms and investing apps that we can use to invest our money. And now these are some of the best on the market in my opinion. And if you've noticed, I've broken them out into two categories: the OG brokers and we have the modern day brokers. The OG brokers are essentially those that have been around for the longest. So these are like your big four banks like your CBA, Westpac, and ANZ. And then you've got your modern day brokers who have really come onto the scene in the past 2 to 3 years. And you have your South Wealth, you have your Perla, you have your Stake, and Weebles. Now, we won't be going into detail about each and every one of these brokers, but essentially the OG brokers have been around for the longest, so they could be perceived as being more well-known and more secure. However, because they've been around for so long, the websites and their investing apps aren't the most intuitive and user-friendly to beginners. And oftentimes the fees that they now charge are significantly more compared to modern day brokers. For example, one of the very first trades that I made was with ComSec 6 years ago, and I paid $52.57 to purchase 270 shares of VTS. Fast forward to today, if I made that same trade with a modern day broker, I would pay only $3 in fees. So if you're brand new to investing, I would highly recommend signing up with a modern day broker, because not only are their investing platforms a lot more intuitive and user friendly, the fees that they charge are significantly lower as well. Now, speaking of another modern day broker, Weeble are currently running a promotion for new customers who sign up to their platform, and deposit any single amount into their account with 12 free shares worth up to $1,200 US. I'm not being sponsored, but if you do sign up using the link in the description box, you'll be helping out me and this channel, and that will go a long way. So thank you in advance if you do sign up using that link, but if you don't, that's okay as well. I'll leave some other links of other brokerage platforms that you might want to check out, such as Stake, in the description box down below. Okay, so when should you actually start investing? Now, before you actually open up your first brokerage account, there are actually 2 steps that you should be doing that most personal finance experts agree on. Firstly, you need to build up an emergency fund. You can start off with a month of savings, but eventually you'll want to build this up to at least 3 to 6 months worth of expenses. And we're talking about the bare minimum here. So your expenses for your rent, your utilities, your transportation, essentially what is the bare minimum that you need to get by on. And secondly, you should be paying off all of your debt with the exclusion of your house. And you specifically want to focus on debt with high interest rates. So think of things like your credit cards, your personal loans, or your car loans, essentially anything with 8%, 9%, or 10% interest rate. These should be tackled immediately after building up your emergency fund. The power of taking these 2 steps alone are extremely powerful when it comes to your own personal finance journey. Now, once you've taken these 2 steps, then you can begin investing your money as soon as you can. And the earlier you begin investing, the more time we have to allow compound interest to do its magic, like we saw earlier in the video. Okay, now finally, what to do after you've actually invested your money. Okay, so you've actually now invested your money into the stock market, which, believe it or not, was actually the easy part. The hard part comes next, and that's called waiting. How you manage your emotions and your risk tolerances is probably one of the single most important aspects to building wealth over time, because growth, unfortunately, isn't a straight line. It goes essentially up and down like this over time. Some years it might be up 30% and other years it might be down 10%. And this year, unfortunately, the markets have been down. And most people can't stomach all of the twists and turns that come with investing into the stock market. And over the past year, things have definitely looked a lot dicier than previous.
But it does seem we are kind of slipping into a recession, doesn't it? People are going to feel a lot of pain.
Concerns, of course, about the potential recession, they continue to loom.
In a poll for the Wall Street Journal, economists put the probability of a recession in the next 12 months at 61%.
And the fear is that we are much more likely now heading toward a recession.
But what you have to understand is that no one can actually predict what the stock market is going to do. No one could have predicted that after the recession that we had in 2020, where the market dropped by over 30% in a matter of months, that the market would then over the next 12 months come roaring back and reach new all-time highs. As a long-term investor, the single most important thing that we can do is to simply shut out all of the noise that we're hearing externally and consistently invest into the market. It doesn't matter if the stock market is up, it doesn't matter if the stock market is down, just continue to consistently invest. Every month, set up an automatic transfer from your bank account to your brokerage platform. It could be for $100, it could be for $500, or it could be for $5,000. And then regardless of what the stock market is doing, you'll continue to buy shares. So when the stock market is more expensive, you'll buy less shares. When it's cheaper, you'll buy more shares. And this strategy is essentially called dollar cost averaging. And over time, it's been found to significantly outperform trying to time the market. All right, guys, if you've enjoyed the video, I hope that it's been incredibly valuable to you as a beginner investor. If it has, share this with your friends and family who you might feel would benefit from this video as well. If you've enjoyed any of the content as well, make sure to hit that like button and subscribe to the channel, because that really does help out the channel a lot. And make sure to check out some of the links in the description box, which will help you get started with investing. Now, before you move on, if you want to learn more about the world's simplest investing portfolio for Australians out there and how I personally essentially invest, make sure you check out this video right here.